Hello, everyone. I'm Teacher Jonna of Accountancy, Business, and Management. Welcome to our class in Fundamentals in Accountancy, Business, and Management 2. Today, we will be discussing Activity 4 as an exercise for our Statement of Changes in Equity. Okay, now we will see the formula for the Statement of Changes in Owner's Equity. It begins with the equity beginning. Normally, we get it from the ending balance of the previous year, or we, we get the owner's initial investment plus the additional investment of the owner plus the net income for the year taken from the statement of comprehensive income, and we deduct the owner's drawing or the withdrawal. Or if ever there is a net loss for the year, we also deduct it from the owner's equity, giving us the total owner's equity at the end. Okay, now we have here a problem activity 4, which requires us to prepare a statement of financial position and a statement of changes in owner's equity given the following data. So the unknowns are the capital beginning, total assets, total liabilities, and equity. So here is now the answer. The statement of financial position starts with the assets, of course, and the accounts receivable has an allowance for doubtful accounts. So we get the net realizable value of 50,000. Then the accrued income. What is an accrued income again? Well, this is a receivable account. This is an income earned but we haven't received yet. So accrued income is under assets as a receivable account. Then the machine has an accumulated depreciation. So we get the net book value of the machine which is 50 less 10. It will give us 40,000 plus the goodwill. A goodwill is a form of an intangible asset, which means this is the name, the good name, or the reputation of the name of the company in the business community. Then we have the liabilities and owner's equity. For liabilities, we have the accrued expense. When we say accrued expense, this is a liability account because this is an expense incurred, but we haven't paid yet. So that falls under the liability account. And the unearned income is an income already paid but not yet earned, or we haven't delivered it yet, or we do not earn it yet, but we have received the income. So that is a liability account plus the notes payable. So it will give us a total liabilities of 100,000. 50,000 capital beginning is, I think, the unknown. Okay? So, to solve for your capital beginning, you have to solve backwards. Knowing that your total assets is 295,000, so that means that will also be your total liabilities and equity. So 295,000, you deduct your assets of no, you deduct your liabilities of 100,000, so you have a remaining of 195,000 for the equity account. So you sold backward again. Total capital at the end of 195 plus drawing of 55 will give you 250 less 150 net income will give us an additional investment of 50,000, and the remaining 50,000 is your capital beginning. So that is how you solve the unknowns in the given information. Okay, now let's have another activity. Activity 5. Activity 5 requires us to prepare statements of financial position and the comprehensive income and the changes in equity, in the owner's equity. Okay, let's discuss this one by one. Take note, there is an adjusting entry also of merchandise inventory in the amount of 50,000. So the first account, the first problem is Okay, I'm lost. I'm looking for the slide. Okay. The first problem is this one. Okay, made initial investment of the following assets on January 1, 2019. Cash 1,500,000, merchandise inventory 200,000. Of course, you have to debit your assets, which is cash and merchandise inventory. Where did we get these two forms of assets? From the equity contribution. So we credit the equity contribution of the owner, 1,700,000. Okay, next. Okay, bought machine on account, 350,000 on June 30. So on June 30, they bought machine, and it says here we have to compute depreciation. It has estimated useful life of 10 years with a salvage value of 5,000. We will compute the depreciation at the end of the year, okay? But for now, we have to acknowledge the addition of us an additional asset in the form of machine. So you debit 350,000 for machine, and since it was bought on account, we credit an accounts payable. Then borrowed on May 31, 2019, 2 million at the bank for a term of 5 years with a 12% interest per annum. So for now, we have first to acknowledge the addition of our cash, the increase of our cash in the amount of the loan proceeds of 2 million. So if we acknowledge the cash as the loan proceeds, we also have to record the loans payable to the bank, 2 million credit. Next, we have received cash sales, 4 million. We already know that sales is a credit account. So we acknowledge the sales on the credit side. And since it is a cash sales, we have to acknowledge or record debit cash, 4 million. Then we have sold on account, 200,000. So sold on account, 200,000. So when we say sold on account, that is a sales. So sales is a credit balance. So we record sales, 200,000. And since it is on account, we have to record the receivable. Okay, accounts receivable, 200,000, and then credit sales. Then we also have he paid rent, 15,000. So that is a rent expense of 50,000. Why did we debit rent expense? This is an expense account. And then he also has to disburse cash. So his cash was deducted by 15,000, and we do it by crediting the cash. Next, we have withdrew 15,000 for his personal needs. So if the withdrawal was done by the owner, so that means there is a decrease in the equity. To decrease the equity, we use the drawing account, and to decrease the asset cash, because we will be paying him his withdrawals of 15,000, we credit cash. Then we have purchased merchandise, 300,000, paid half, and the other half on account. So we debit purchases. Why did we debit purchases? So that we will be able to track the cost of goods being bought by or being purchased by the company. So he recorded purchases, 300,000, and since it was paid half, so you have to credit 150,000 for the cash, and the other half was on account. So we have to acknowledge an accounts payable of 150,000. Paid bank loan amortization on December 31, 2019. So when he paid bank loan amortization, his loans payable will be deducted by the same amount. So loans payable was originally a credit account, but since we will be paying or reducing our payables account, we do the opposite. We do a debit loans payable, putting the loans payable account zero balance. And the interest expense is a debit side because that's an expense, 140,000, and he has to disburse cash. So we credit cash by 2,140,000. But how did we compute for the interest expense of 140,000? Okay, let us see this formula. Add this solution. Borrowed on May 31, 2 million at the bank for a term of 5 years with a 12% interest per annum. So how do you solve for your interest? So principal loan of 2 million times the term of 5 years times the bank rate of 12%. So when you multiply these three, it will give us, oh, how much is that? 1,200,000. So 1,200,000 is the interest for 5 years. But we are not computing for 5 years yet. We are just computing for the loan or the interest from May 31 to December 31. So since 1,200,000 is for 5 years, we have to divide it by 5 to get the yearly amortization on interest. So 1,200,000 divided by 5 years will give us 240,000 per per year. So the interest per year is 240,000. But since we use the money not a whole year, but from May to December, that is May 31. So June to December 31 is 7 months. So we have to divide 240,000, which is the interest for 1 year, divided by 12. So it will give us 20,000 per month times the 7 months that there was no interest paid. So 7 times 20,000 is 140,000. So 140,000, we can also compute it this way. 2 million times 7 over 12. Why 7? Because the date started June 1 to December 31 is 7 months. 12 because there are 12 months in a year times the interest rate of 12%. Okay, so that's very, very easy for us all, but we need to be familiar with the solutions. Then we have to compute also for the depreciation. So account number two or transaction number two says he bought machine on June 30. So we have to take note of the date. So on June 30, that means from June 30 or July 1 to December 31 is how many months? Yes, that is 6 months. So if that is 6 months, we have to compute first for the depreciation cost of 350,000 minus the salvage value of how much? The estimated useful life with the salvage value of 5,000. So 35 less 5, 350 less 5 divided by the estimated useful life of 10. So 300 it becomes 345 divided by 10. It's 34,500 per what's this? 84 I can't see. Okay, 350 less 5,000 divided by 10, it will give us 345 divided by 10 is 34,500 divided by 12 because we are computing for at least a year. We would like to find out how much is the depreciation per month. So we divide this per year by the number of months, so 12. So the answer is 2,875 amortization of depreciation per year times 6 months. Why 6 months? Because that is from July 1 to December 31. Times 6 will give us 17,550 as the depreciation. Okay, next, we have an adjusting entry also. Okay, I think it moved so fast. Okay, here. The adjusting entry, the depreciation is 17,250. Then the merchandise inventory of 50,000. Okay, then we prepare the ledger. So from all the accounts, I think there are only three accounts which have changes. So one of which is the cash account. The numbers on the left represent the transaction number, and the numbers corresponding the that number on the left is the transaction value. So if we get the total of the debits and we deduct it from the total of credits, we have a total debit balance of 5,180,000. Yes, 5,180,000. Then we have the accounts payable has 500,000 balance, and the sales has 4.2 million sales. Then we have to show now the balances of all the accounts. So from the ledger above, we discovered that cash as a debit balance of 5,180,000, and the rest were given in the problem. Okay? Now we have the trial balance. All the accounts with normal debit balances should be placed in the debit column, and all the accounts with credit normal balances should be placed in the credit column. So if we do that, we can get what's this? We can get a debit balance of 6,417,000, and the 6,417,250 also for the credit column. Okay. Next we have yeah. Then we have the statement of comprehensive income. We also got this information from the information above. Okay, so sales is 4,200,000, and so on and so forth. But we have here the ending inventory, so we have to deduct ending inventory and show the 450,000. In the net income, okay, we've reduced the sales. Less 450,000, 1,720,000. Sorry, one uh, 4,200,000 less the gross profit or cost of goods sold of 450,000 will give us a gross profit of 3,750,000. Gross profit of 3,750,000 less the expenses will give us. Okay, it's if you will notice, it's included here in the expenses, the rent, the interest, and the depreciation. So it will give us a total of 172,250. So minus the gross profit less the expenses will give us a net income of 3,577,000. And now we have the ABC Company statement of financial position. So if you want to see the balances of these accounts, well, we can. I think I'm also coming closer to the computer. So that is 50 cash, merchandise inventory, etc. Until we arrive at the total assets of 5,762,750, and that's also the total assets and liabilities of Ronald of ABC Company. Then we have okay, now we have the next activity. This is activity 5. Yes, I think this is activity 5 or 6. Given are the data for the entries, journal entries that you will be preparing, plus the trial balance, plus the statement of changes in financial position, and the changes in owner's equity. Okay, I think that's all for now. See you on our next lesson. Congratulations if you have reached this point. My goodness, you are doing a big progress. So, again, thank you very much, and God bless everyone. Again, I'm at your service, ABM with Teacher John.